So the Fed's decided to leave rates unchanged today. What does that mean for real estate or mortgage rates? Welcome to Dre's Take. Today, the Federal Reserve decided to leave its benchmark rate unchanged, still sitting around 4.3% or so. They also noted that they expect slower economic growth this year and potentially next year than they previously predicted, suggesting that unemployment may also tick up to about 4.4%. Now, when we talk about slower growth and unemployment going up, we typically would assume that that means bad news for the economy, which on one hand it sort of does, and on the other hand, when it comes to these interest rates that we've all been hoping will drop, it's actually good news. You see, if you read between the lines, what the Fed actually needs or wants is cooling inflation. And the way that you get inflation to cool is to restrict spending. And the way you get restrictions in spending is quite literally if people have no money to spend. And so the unemployment rate ticking up is good news to the Fed in terms of their pathway forward for reducing interest rates. And so today what they said was, we expect some temporary inflation to increase due to the Trump tariffs, etc. And so we're going to leave rates unchanged, but we do expect to cut rates 2 more times this year at least. Now, back to the whole inflation may rise temporarily thing. There's a couple of mixed signals here. Although they do think that maybe temporarily we may see some upward pressure on pricing due to the tariffs, they do note that other administration policies, such as deregulation and increased domestic energy production, may kind of balance that out or be a wash altogether. But they want to have more time to wait and see just how that fleshes out, so no rate cut today. The markets reacted positively, equities increased, the S&P was up over 1%, the volatility or VIX rate was down, and the 10-year Treasury note was also down, which is good news for mortgage rates in the short term. More big picture thinking here though, in terms of what it means for mortgage rates, today's news just means that things are going to be stable. They're not really going to move mortgage rates much, if at all. So we're still going to be in this 6.6, 6.5 range, probably for a couple more months. Some of this is good news. This is stability within the mortgage rate environment. And it is down from the 7% rates that we seen last year or early in the year, which allows buyers to shop with more confidence. As of right now, everybody's just kind of holding tight. We're in a holding pattern. A lot of listings are kind of just sitting, not a whole lot of buyers in the marketplace, despite it being the springtime market. And to those people, I would really just say, be patient. It's not just you. I talk to realtors and title companies and lenders all day, all the time. And essentially, they're all saying the same thing. We can't get anybody to walk through our listings. And when they do, I've got realtors calling my phone saying, hey, please make an offer, basically begging. So if you're a seller in that situation right now, just know that you're not alone. If you're a buyer, hey, now's the time to strike before the rest of the competition comes back into the marketplace. You might be able to snag a good deal with a great negotiator on your side. And that's pretty much it. I'm going to keep it short and sweet because I had a super long day. It's like 7 p.m. and I just wanted to make sure that I was putting out a good piece of valuable content for you guys today. And so that is going to be Dre's Take. The gist of it is the Fed left rates unchanged. That is going to leave mortgage rates unchanged. In the short term, we may see some more turbulence in the overall general economy, but in the long term, it sounds like we've got a pretty decent prognosis for rates to come down further and things to start expanding again. Until next week, that's Dre's Take. Take care, y'all.